Hello and welcome to Morningstar. I'm Emma Wall and I'm joined today by Lewis Grant, manager of the Hermes Global Equity Fund, to give his 3 stock picks. Hi Lewis.
Hi there.
So what's the first company today?
So the first company is American Waterworks, which is a US water utility company.
Sounds like it does what it does on the says what it does on the tin.
It does. I mean, you might be forgiven for thinking it's quite a boring company, and I'm not actually going to try and dissuade you of that notion. And that's why I like it. I think in this market, with so much volatility, so much uncertainty about which way the economy and certainly which way the market's going to go, companies like American Waterworks offer a lot of earnings visibility. The water industry in the US is very highly regulated, which means we know what earnings the company's going to make. It's also an industry that's dominated by the municipals. Most of the water is actually supplied publicly, but they're beginning to sell off those facilities, and that allows companies like American Waterworks to actually grow their earnings. There's also a huge infrastructure investment program, and again, that's a regulated industry that earns just a steady return, but there's great transparency. And so a company like this that's paying a 2.5% dividend yield that offers so much certainty over its cash flows really can do well regardless of what happens in the wider economy, and that's why we like it.
I suppose usually a utility is the sort of stock that offers little to no growth but a nice dividend, but you're saying because of the regulatory background actually this offers growth as well?
That's right. I mean, it's not a high growth stock, I don't want to claim that, but certainly 5 to 6% revenue growth, that's actually quite attractive for a utility, and that is just because they are starting to privatise so much of the water facilities. And a company like American Waterworks can come in, modernise the technology, make everything more efficient. That works for everybody. It's a win-win for both the public and the private companies.
And what's the second stock today?
So the second stock is O'Reilly Automotive, which is a company we've spoken about before. It is an auto parts retailer, and they service both the professional mechanics and garages as well as the DIY kind of home enthusiast user. And that's why we like it so much, because it's a company that's not particularly economically sensitive. You might think a retailer, and certainly something involved in autos, is going to do very badly when the economy dips, or if the economy dips.
Well, they do say that, don't they? They say the auto industry is a barometer for the economy in the US in particular. Absolutely.
But O'Reilly's very different because they're servicing older cars that need maintenance. So actually, when the economy dips and people can't afford a new car or can't afford to take their car to the garage, they go to O'Reilly to fix it themselves. Or with the oil price so low, so fuel's so cheap in America, people drive more, so their cars need more maintenance. And again, O'Reilly does very well then. And so what we like about it is a very high growth stock. I mean, over the last 7 years, they've achieved 20% earnings growth every year. You know, for the last 23 years, they've increased same-store earnings growth. I mean, this really is a very consistent high growth name, and yet it's not particularly economically sensitive. That ticks all the boxes for us.
And what's the third and final stock?
So the final stock is a little bit closer to home. It's a Spanish wind turbine maker, which is Gamesa. Now, renewable energy is obviously
hot topic.
Absolutely it is. Following the climate change conference in Paris, everyone's talking about it. But they've been talking about it for years, really. It's just not been a very investable technology. And that's because it's been so expensive. But certainly within the wind industry, within wind energy, is now, in some territories, reaching grid parity, which means it's actually comparable to producing energy from fossil fuels. So suddenly it's a viable alternative without relying on government subsidies. And that makes this a great time to get involved. And a company like Gamesa has got to focus on emerging markets. I mean, Gamesa is basically the emerging market play within wind energy. And so countries such as Brazil, Mexico, and particularly India. India is going to be more than doubling its wind energy contribution over the next 6 years. That's a huge investment, and Gamesa is the market leader there. So it's a great time to get involved in a technology that we absolutely need to embrace to ensure that climate change doesn't really affect us to the worst that it could.
I mean, you mentioned briefly the sort of government support. I know that in particular the UK-based renewable energy companies have been hit by the fact that subsidies have been significantly reduced, in particular solar, which I know is a different market, but the same sort of fundamentals apply. Are you saying then that actually we've reached a point when, you know, even if there were no subsidies, this company could still do well?
Absolutely. I mean, not in all territories. You're right that it does depend on the geography and on the current mix of fuels. But if you look at the likes of certainly Mexico, India, these are opportunities here without government subsidies for companies like Gamesa to expand. So we're at a tipping point for wind energy now that it could actually become a significant part of our energy mix across the globe. And it needs to. I mean, the projections say that by 2050, we need to be getting 20% of our energy from wind power. Well, currently it's less than 3%. And this is a huge growth industry, but now it's actually affordable as well.
Great for shareholders and the globe.
Absolutely.
Lewis, thank you very much.
Thank you.
This is Emma Wall for Morningstar. Thank you for watching.